Back in 2022, when Alibaba was trading at its lows and the market was terrified of Chinese equities, we made BABA the biggest position in our portfolio. We presented our bullish thesis, we held through the volatility, and if you follow our research since then, we are looking at gains of over 143%. But here is the critical question. Is the trade over? Absolutely not. In fact, the story has completely changed. We aren't just looking at a value recovery anymore. We are looking at the emergence of a tech superpower. The Chinese economy is rebounding, the tech gap with the US is closing, and Alibaba has quietly transformed into what I call the Chinese AI ETF. If you think you missed the boat, you need to see the numbers we have uncovered for 2026. Welcome back to the channel. Let's break down why BABA is heading to $300 per share. If you want to find the best opportunities in the market before everyone else, make sure to subscribe to MoneyJourney channel right now. Let's dive in. So, what is driving this new optimism? It's no longer just about selling products online. It's about owning the infrastructure of the future. Alibaba possesses the largest cloud service in China, but their strategy to monetize it is what makes them genius. They are currently acquiring equity in almost every major AI startup in China in exchange for cloud computing power. This effectively makes BABA an index fund for the entire Chinese AI revolution. While investors worry about lower free cash flow, you need to look closer. That cash is being heavily reinvested into AI infrastructure, and the returns are already visible. Their AI cloud segment is growing at triple digits. This is a classic capex now for dominance later play. Furthermore, the incentives are perfectly aligned. China cannot compete with US tech without a domestic champion, and that champion is Alibaba. They are not getting disrupted, they are the disruptors. With proprietary chip designs and an embedded ecosystem that the entire country relies on, the future of China's AI ambition is inextricably linked to the success of this company. This is a massive competitive moat that the market is finally waking up to. Alibaba fundamentals remain strong as ever. When you look to our MoneyJourney checklist, in terms of revenue, they have been growing around 23% per year, and the potential to grow, it's only 6% earnings per share in the next few years, but that's only happening because of they are heavily investing. If that was not for the capex or high capex they are expecting for the next few years, they will be growing double digit, and that's very good growth for Alibaba. When you analyze the revenues going up steadily, profits not going up as expected because 2021 was a great year, but if you look to margins, the gross margin were coming down, but they are recovered for the last 2 years. So even though they are expecting to invest a lot, I believe when this pass, their margin will recover, and Alibaba will be a very profitable company. In terms of the quality of their revenues, it's a consumer base. I would not say that's high quality, but this part of their business, cloud business, AI subscription, are increasing the quality of their revenue. So this is very good and a very good competitive advantage. So they deserve a premium, or at least these revenues from cloud deserve a premium. They have been investing a lot to their products. They are innovating their Taobao business. They're implementing AI across the board. So they are investing a lot in R&D. So it is a company that is investing a lot, and I believe they will be very successful. That's why I'm really bullish on Alibaba. In terms of margins, gross margins around 40%, which is not bad. Profit margin around 18%. So I believe their profit margin, net income margins, or free cash flow margin in the future, when this high capex stabilize, it will be between 15% to 20%. It will depend, but we'll see, because it is a shift change on Alibaba. They are getting more technologically advanced. In terms of maintaining profit margins, kind of, I would say. Gross margins recover now 40%. their free cash flow margin is around 15%, which is very good, I would say, for a company like Alibaba when you compare to other peers like in US, Amazon, for example. Their cloud business is only now getting profitable, so I'm expecting their cloud business to be very profitable, so it will increase margins for Alibaba business overall. They have plenty of pricing power, not from the e-commerce, but from cloud AI. So they will be the leader, and AI on China is getting very dependent on Alibaba. So that they have a pretty good balance sheet, more cash than that. So that's why they are in a very good position to invest heavily. Rates of return they will recover are close to 10%, which is not bad or good. I would say I prefer higher returns on invested capital. But let's see. I believe this investment they are doing on AI will get higher returns. So return on invested capital, since it's dependent on net profit, and right now they are investing a lot, so they are on a better position. But with profits increasing, I believe this return of investor will be very high in the near future. In terms of management, very good. I really like, because when the company was cheap in 2022, 2023, they do plenty of buybacks. They bought back, let me see, 3% in 2023, 3.6% in 2024. Fiscal year of 2025, they bought back 5.1% of shares. So that's a good sign that management is very competent, because other companies, when the stock is higher, when there is a lot of optimism, they do plenty of buybacks. And when free cash flow goes down or the company is doing bad, for example, they cut the buybacks. It should be the other way, like Alibaba is doing. When the company is undervalued, that's when management should be increasing their buybacks. They should act as an investor. For me, if a company is at a lower valuation, the price of the share price is low, and I believe the company deserves a higher price, that's when I will buy the company, and as management should do the same as buybacks. That's how you create value for shareholders. In terms of competitive advantage, yes, their moat is growing. They have their network effects, efficient scale on their e-commerce business. With cloud, they have high switching costs. Once a company is using their cloud business, it's very difficult to change, or at least it will be needed costs in form of time. So they their company adapts to that. They've been growing free cash flow per share around 12 to 13%, which is a very good growth, and they're returning capital to the shareholders. Even though they are investing heavily, they still have a very good balance sheet that can provide to increase the returns. They are doing buybacks, they are paying a dividend. So overall, it's a very good and very fundamental strong company with a quality score of 75. Question: is it cheap? It was very cheap in the past year. Right now, let's see what our valuation says, but for me, it's still cheap because they have a lot of potential right now, and still investors, momentum is changing, but investors still have plenty of growth ahead. Is it a good business? Very good. Of course, there are some bear cases. That's always a Chinese business. Government can always interfere, even though their incentives are aligned right now, but it could change rapidly as it happens in the past. If Alibaba is investing a lot and they don't see returns on this investment with AI, the stock will tank in the future. Could see delisting, economic war between US and China, so we alert both economies. But overall, we can find the three sources of returns. We will see revenues and earnings growth. We can see a PE expansion, of course. Right now, they are trading at the 20, around the forward PE around 20 or 19. Of course, there are two bullish cases on that, because earnings are not troughed. They are earnings around 15 to 20 billion, but Alibaba at this position right now, without AI growth, they could bring 25 to 30 billion dollars of free cash flow. So earnings are not at the maximum margins, I would say, because they are investing a lot and changing some segments around the company. So because of that, earnings are not at the maximum. So this 20 PE looks like a 15 PE, I would say. And then, of course, they deserve a higher premium right now because higher growth on the cloud. Cloud deserves a bigger premium in terms of P, for example, P ratio, because of the quality of these revenues. There are more subscription based, so more recurring, so margins could increase as well. So with a company with higher margins, with a higher revenue quality, deserves a higher valuation. That's why I believe they could continue to expand their PE, and they are doing buybacks and dividend to create value for the shareholders. But is this still cheap? What is our valuation for Alibaba right now? So for me, it's a Chinese company, so plenty of risks, country risk. In terms of business, I assume a medium risk, even though in terms of company, Alibaba is a very safe company, but I will be conservative here. So with this, I believe to invest in Alibaba, you should consider a discount rate of 15%. With that, I think you have some margin of safety, assuming that. Of course, there are country risk, but in terms of business risk, Alibaba has a big wide moat, and that's increasing that moat and that competitive advantage. So, and with that balance sheet, it is a very safe investment inside China, but of course there are the Chinese risk. So my base case, I'm assuming them growing only 7% per year. If cloud gets or grows into a bigger part of Alibaba business overall, with this growing 30-40%, revenues from Alibaba Group will grow above 10%, but I'll be conservative here, only 7%. I think they deserve a 20 PE and free cash flow margin of 17%. So with that assumptions, I'll do a bear case and bull case as well. So I came with an intrinsic value of around $184 per share. Around 185. Right now the stock is trading at around 173, so pretty close. I would say fair value right now, in my opinion, trying to be conservative, will be between $180 to $200. We are getting closer to a fair value, but of course, if this AI hype turns into a very profitable business, turns out Alibaba is getting a better business overall, of course they will deserve a higher premium in terms of valuation. You could see even this year Alibaba have another 80% plus year like 2025. To wrap this up, the risk-reward ratio here is still incredibly compelling. Even if you take a conservative approach, pricing in the China risk and ignoring the massive potential of future AI profits, our model still shows an intrinsic value of $185 per share. But if the cloud growth continues to accelerate towards 40% or more, and the AI optimism holds into 2026, we are looking at a roadmap back to $300. So, testing those all-time highs that we have seen in 2021. The fundamentals are strong. The incentives are aligned and the momentum is real, but I want to hear from you. Do you believe Baba can actually catch up to its US tech counterparts, or is the geopolitical risk still too high for your portfolio? Let me know in the comments below. If you found value in this analysis, please smash that like button and subscribe to MoneyJourney for more high conviction investment research. I'll see you in the next video. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.